Good day, everyone. Hi, future CPAs. I am Hazel Lenon, a former BSA student of LaSalle. I am here to give an overview of auditing theory in preparation for your upcoming exams. Before we begin, a few reminders. Don't forget to eat and sleep properly, pray, and take breaks while preparing for your upcoming exams. We all have our own paths in life, and your path involves taking and passing these exams and becoming a CPA. Okay, so let's begin. First, we will define auditing. The auditing process begins with the independent auditor. Okay, so how to be independent? Being independent as an auditor involves independence of mind and independence in appearance. Having an independent mind means that the auditor relies only on his or her own mind in performing the audit and in coming up with an opinion. It means that there are no bias, external influence, or outside pressures that are acting on the independent auditor's mind. Independence in appearance is defined as the public looking at the independent auditor and seeing that the auditor does not rely on other factors and external parties in performing the audit. The auditor can refer to the Code of Professional Ethics for CPAs, Philippine Standards on Auditing, and professional skepticism in order to be independent. More on professional skepticism. In being an auditor that exercises professional skepticism, the auditor must look at management not as fraudulent, neither does it look at management as honest. It means that the independent auditor has an alert and open mind when conducting the audit. It looks at the audit and the evidence objectively, and it doesn't assume that management is being honest, nor does it assume that management is being fraudulent. Now, what does the independent auditor do when conducting the auditing process? It follows a systematic process. It means that the auditor has a specific set of processes and procedures that it follows when conducting the audit. The auditor does not freestyle the performance of the audit. It has specific steps and procedures that it follows, okay? So in this systematic process, the auditor objectively obtains and evaluates evidence, okay? So what is this evidence for? What does the auditor do with this evidence? The auditor does this in order to establish a degree of correspondence between assertions and established criteria. To make it simpler, let's break these down. Assertions are representations made by the auditee, or in other words, the client. The client, in its financial statements or other accounting information, it informs the auditor about economic conditions or happenings in the business. It gives these to the auditor in the form of representations or assertions, while the auditor compares these assertions and judges these assertions using established criteria. And whatever the results may be, the auditor communicates these to interested users. Okay, so in order to further understand this, let's look at an example. When auditing financial statements, the auditor judges the fair presentation of financial statements. Let's say the management of the client, it approaches the auditor and says that, "Auditor, my financial statements are fairly presented." This is an assertion, a representation made by management. It tells this to the auditor. And the auditor, upon receiving this information, the assertions made by management, the auditor compares this with an identified financial reporting framework which serves as the criteria for judging. So the auditor looks at the financial statements which management asserted to be fairly presented, and the auditor judges this. It looks at the PFRS, or an identified financial reporting framework, and looks if it really is fairly presented or not. And whatever the results may be, when the auditor finds out that the financial statements are not fairly presented, or has other modifications to it, whatever these results may be, the auditor will then communicate these results to interested users. Okay, so that's a general definition of what auditors do in the auditing process. Next, we're going to talk about why is there a need to have an independent FS audit? Why do we need to do these financial statement audits? First, because of conflict of interest. The management, which prepares the financial statements, would like these financial statements to be as flowery, profitable looking, and successful looking as possible. So management would like to do its best so that these financial statements are attractive and eye-catching to its investors and to the general public. While on the other hand, the users of the financial statements would like these financial statements to be as accurate as possible. So the users of the financial statements and the management have a conflict of interest. They have different interests when it comes to the financial statements. The independent auditor is there in order to bridge the gap between the management, who would like these financial statements to be as profitable and attractive looking as possible, and the users of the FS, who would like these FS to be as accurate and fairly presented as possible. Also, not all users of the financial statements have the expertise to examine the actual conditions of the client and see if these actual conditions are reflected on the FS. So, the users rely on the independent auditor to use their expertise in examining the financial statements and seeing if they really do reflect the economic conditions of the firm, or of the client rather, the management and the client. Next, remoteness. So, not all of the users have the capability to directly inspect and look at the client and see if the happenings in the client's organization are reflected in the FS. So, the independent auditor is hired so that they will be the one to examine these economic conditions and events and see if they are reflected in the FS. Lastly, financial consequences. When users of the financial statements look at the FS, they use these financial statements in deciding about their finances. So, the decisions that they make depending on these FS have financial consequences. In order to have gains or good financial decisions on these FS, the financial statements have to be fairly presented, and they have to not have any material misstatements so that good decisions can come out of them, and that the users of financial statements will be able to be contented and approve of the decisions that they make depending on the FS. So the auditor does its best to conduct the audit and to come up with an opinion of the FS, so that the users may be able to use this opinion and avoid any negative financial consequences when using the financial statements. Next, as an auditor, when do we have to be independent? So, we have to be independent when performing assurance services. When the auditor is performing an FS audit, the team The firm and the network firms all have to be independent. When performing a non-audit, which is not restricted in terms of viewing, meaning the general public and interested users may all be able to see the results of this non-audit, only the team, the engagement team, and the firm have to be independent. Lastly, when performing a non-audit, in which the results of the non-audit are restricted to those who requested those services, only the audit team is requested or should be independent. Next, we will look at the types of audits and auditors. Okay, so upon glancing at them, we have the financial statement audit, compliance audit, and operational audit as the types of audits. So, upon looking at their definitions, we see that the FS audit determines whether financial statements are fairly presented in accordance with an identified financial reporting framework. So, based upon the explanation on the previous slide, similarly, the auditor compares the assertions with an identified financial reporting framework and sees if it is fairly presented. Next, in a compliance audit, the auditor will check to see if the client adhered to specific procedures, rules, or regulations. In an operational audit, the auditor will assess the performance of the client, look at it to see if there are improvements and recommendations. So in these three types of audit, the auditor will examine the client's operations, but it is different on what it will actually be looking at. For operational audit, the auditor will assess the performance and operations. For compliance audit, the auditor will look if the client actually complied with specific procedures. And in FS audit, the auditor will look if the client's financial statements are fairly presented. Okay? Next, we have the auditors. We have external auditors, internal auditors, and government auditors. What do external auditors do? The external auditor renders professional services to different clients on a contractual basis, okay? These external auditors are the ones we usually see in auditing firms, while internal auditors are the entity's own employees working on the client's business themselves. They investigate effectiveness, efficiency, and internal control of the company that they are working for. For government auditors, they determine whether entities comply with government laws and regulations. Next, who has responsibility for the financial statements? Is the auditor the one who is responsible for preparing the financial statements in accordance with a financial reporting framework? The answer here is management. The management of the specific client is responsible for the financial statements, while the assurance provided by the auditor in an audit is reasonable, not absolute. This means that when an auditor audits the financial statements to see if there are no material misstatements and to see if it is fairly presented in accordance with a financial reporting framework, the auditor is not 100% sure about the results and the opinion. It can give only a reasonable and not an absolute assurance. The reason is because in performing the audit, there is sampling risk, judgments performed by the auditor, management's representation, clients' accounting systems, and the nature of evidence that the auditor is handling in conducting the audit. This is the reason why there is no 100% or absolute assurance in an audit and only a reasonable assurance. Next, we go to assurance engagements. The purpose of assurance engagements is to enhance the credibility of information, okay? So, whether a particular engagement is an assurance engagement will depend upon whether it exhibits all the following elements. So, in order for us to judge if it really is an assurance engagement or not, we need to check if the certain engagement has these 5 elements. Okay, let's go over them one by one. The first is a three-party relationship. So an assurance engagement must have a three-party relationship, wherein these three parties are the practitioner, or the auditor, or the accountant, and the responsible party, which is the client, and the intended users, the people who will actually be depending upon the financial statements of the responsible party to make their decisions. Next, the engagement has to have an appropriate subject matter. So when we talk about subject matter, these aren't only the financial statements or the numbers and amounts. The subject matter can be in the form of data, systems, behavior, and physical characteristics of the client's company. Next, we have suitable criteria. These are the standards or benchmarks that the auditor will be using in the auditing process. Next, we also need to have sufficient appropriate evidence. When we talk about the sufficiency of evidence, we are talking about the quantity of the evidence that the auditor will be using. And when we talk about appropriateness of the evidence, we are actually talking about the quality of the evidence. Okay? Lastly, the fifth element of an assurance engagement is a written assurance report. So in this written assurance report, we will see the conclusion that provides a level of assurance. So the auditor will be coming up with this, the written assurance report. And in that report, we will see the auditor's opinion or conclusion that provides the assurance. So we may also encounter different assurance engagements and non-assurance engagements. So we will see that non-assurance engagements can come in the form of agreed upon procedures, compilation, preparation of tax returns, management consulting, and other advisory services. Okay, so these non-assurance engagements are actually services, and these different services do not provide any level of assurance. Some additional concepts to remember. We have the reasonable assurance engagement versus limited assurance engagement. A reasonable assurance engagement gives high assurance or positive assurance. An example of this is the audit, while a limited assurance engagement gives only moderate or negative assurance. An example is review. So when we look at an audit, we will see in the auditor's opinion the phrase, in our opinion, the financial statements present fairly in all material respects. This gives us positive or high assurance. On the other hand, when we look at a review, we will see the phrase, based on our review, nothing has come to our attention that these FS do not present fairly in all material respects. So this phrase gives moderate or negative assurance. We also need to remember the concept of assertion-based engagement versus direct reporting engagement. So the difference between the two: in an assertions-based engagement, the responsible party is the one performing the measurement of the subject matter. So basically, all they have to give is the assertion. And these assertions will be examined by the practitioner, the auditor, and they will provide a conclusion on these assertions. Next, in direct reporting engagement, the practitioner will be the one who will directly perform the evaluation of the subject matter. Okay, so a while ago in assertions-based, the responsible party, the client, will be the one who will measure the subject matter and turn it into an assertion. While in direct reporting engagement, it will be the practitioner or the auditor, okay? The practitioner or the auditor will be the one who will perform the evaluation. And then when it evaluates the subject matter, it will come up with subject matter information. Subject matter information will be made available to the users, okay? So next are some key terms: audit, review, agreed upon procedures, and compilation. So in an audit, the end result is the auditor's opinion, okay? In review, the end result is a statement in which the practitioner will state if anything has come to their attention, that the financial statements will not present fairly in all material respects. While in agreed upon procedures, all they have to do is carry out some specific audit procedures that they have agreed upon. Next, for compilation, the auditor has to assist, or the auditor or the accountant has to assist in preparation of FS. When it comes to assurance, audit, high assurance, review, moderate assurance, agreed upon procedures, no assurance, and compilation, no assurance. In an audit, the auditors have to perform risk assessment procedures, test of controls, and substantive tests. While in review, they perform inquiry and analytical procedures. In agreed upon procedures, the procedures are as agreed upon. So whatever the client and the practitioner have agreed upon, only those specific procedures will be performed, okay? And in compilation, the practitioner only has to assemble financial statements. These financial statements will be based on the data that the client will give to them, okay? Next, for an audit and review, independence is required, while agreed upon procedures and compilation, independence is not required. We will now move on to engagement standards and practice statements. So it's good for us to be able to know which engagement standards are being used and also practice statements. First, let's define them, okay? Standards are established to measure quality or performance, and GAAS, or Generally Accepted Auditing Standards, will measure the quality of auditors' performance. The Generally Accepted Auditing Standards is a minimum standard of performance that auditors should follow. So if the quality or performance of the auditors would exceed GAAS, it would be perfectly fine as long as they follow GAAS as a minimum standard. So Generally Accepted Auditing Standards is divided into three parts: general standards, standards of fieldwork, and standards of reporting. So these standards have an acronym for easy familiarization. First, for general standards, we have TIP, T for technical training and proficiency, I for independence, and P for professional care. So it generally means that when conducting the audit, the auditor has to have technical training and proficiency, of course. The auditor has to have the education, skills, and experience to be able to conduct the audit. Next, of course, as we discussed earlier, the auditor has to have independence, and the auditor has to have professional care when performing the audit. The auditor should not be careless or haphazard, because performing the audit should be done carefully in order to provide good results. Next are standards of fieldwork, in the acronym PI. In performing the fieldwork, the auditor should plan it well, The auditor should have an internal control consideration because the internal control of the client is an important aspect to consider. Lastly, the auditor has to gather evidential matter in the field work. For standards of reporting, we have GIDO. In reporting, it should be in accordance with the result should be in accordance with generally accepted accounting principles. The auditor should spot in its report if there are any inconsistencies on the part of the client. And of course, it should see to it that disclosures are made and that an appropriate opinion is given by the auditor. Okay? Next, we have practice statements. So what are practice statements? They are issued to provide practical assistance to auditors in implementing the standards and to promote good practice in the accountancy profession. Okay, so key terms, practice statements, practical assistance, and promoting good practice. So let's look at the practice statements that we have. So in auditing, we have Philippine auditing practice statements. For review, we have Philippine review engagement practice statements. And for other assurance engagements, we have Philippine assurance engagement practice statements. On the other hand, for related services, such as agreed upon procedures engagement and compilation engagement, we have Philippine related services practice statements. So on the left side, beside the practice statements, we have the standards, okay? We are more familiar with the standards. For audit, we have Philippine Standards on Auditing, Philippine Standards on Review Engagements for review. We have Philippine Standards on Assurance Engagements and Philippine Standards on Related Services for those related services, okay? These are the AASC pronouncements. Next is the system of quality control. First, let's define quality control. Quality controls are policies and procedures adopted by CPAs to provide reasonable assurance of conforming with professional standards in performing audit and related services, and that the report issued by the firm is appropriate in the circumstances. So key thoughts here. Quality controls are policies and procedures. For what? What are these policies and procedures for? They provide reasonable assurance that the CPAs are conforming with professional standards, okay? And that the report that the CPAs issue are appropriate. A system of quality control has elements. So as you can see, we can familiarize it through the acronym of HARLEM. Okay, so for H, we have human resources and assignment. So what's the connection of human resources and assignment to quality control? So the firm should ensure that sufficient personnel with competence and ethical principles necessary to perform the engagement are present in the audit. A is for acceptance and continuance of client relationships. So when the auditor and the audit team look at the client, they must consider the client's integrity. They must consider if the audit team is competent enough to perform the audit. And they must check if they fulfill all of their ethical requirements. R is for requirements. L is for leadership responsibilities for quality on audit. So, of course, in audits, the engagement partner has the responsibility. The engagement partner will act as the leader and will show leadership so that the audit will be of appropriate quality. Next, we have engagement performance, and lastly, monitoring. For engagement performance, the engagement partner should take responsibility for the direction, supervision, review, and overall performance of the audit engagement. So when we are talking about direction, The engagement partner should remind the audit team, the assistants of their responsibilities. So when these staff are reminded of the responsibilities that they have, the engagement partner is actually directing them on what to do, directing them on the path and the process that they should take when performing the audit process. And when performing supervision, the engagement partner looks at the audit process. It sees the progress of the audit, where the team is in performing the audit, and looks at any issues that the engagement team might have in the audit. In reviewing, the engagement partner looks at the appropriateness of the work done. Is the evidence in line with the conclusion or the opinion of the audit? Lastly, as an element of a system of quality control, monitoring has to be present. In monitoring, we have the continued observance of quality controls. So we must not perform these human resources and assignment, acceptance, requirements, leadership responsibilities, and engagement performance on a one-time basis only. So as long as audits are being performed and the firm is continuing in its responsibilities, we have to keep up with this and have a monitoring so that these quality controls will not only be performed once or at the beginning of the audit only, but will be performed well throughout the entire audit process and in the future audits to come, okay? Next, in performing the audit process, what is the responsibility of the auditor? The auditor's responsibility is to design the audit to provide reasonable assurance of detecting material misstatements. So where does material misstatement come from? It comes from errors, fraud, and non-compliance with laws and regulations. So if the client commits errors, when the client performs fraud, or the client does not comply with laws and regulations, for sure, material misstatements will be found. What is the difference of these three from each other? So when we have an error, material misstatements are found, but they are only unintentional. The client does not mean to have these material misstatements. For fraud, the client or the staff intentionally performed acts which led to material misstatements. It may be in the form of fraudulent financial reporting or management fraud, which is intended to deceive financial statement users. It is in which the management looks at the financial statements and performs different edits just to beautify or make the financial statements more profitable or more attractive to investors and the general public. In misappropriation of assets, it's also another form of fraud, otherwise known as employee fraud. The difference is that in misappropriation of assets, there is a theft of assets, stealing of the valuable assets of the firm. Next, for fraud risk factors, these are events or conditions that provide an opportunity, a motive, or means to commit fraud. So fraud risk factors are different elements that might be present in the firm or in the client. So the auditor has to take note of this because when fraud risk factors are present, there is a greater chance that fraud might be committed. Here, we have a short overview of the audit process. So, it is divided into 6 parts. We begin with the accepting of an engagement, followed by audit planning, considering internal control, performing substantive tests, completing the audit, and issuing a report. So, we are going to take a look at each of these steps in performing the audit. First, we have to understand what financial statement assertions are. So assertions representations made by the auditee about economic events and conditions. So as I have mentioned earlier, assertions are a key element of the audit process. The assertions are made by the auditee, the client, and they are given to the auditor for the auditor to evaluate and judge these according to the criteria. Next, the assertions are of different kinds. We have three over here. The first are assertions about classes of transactions and events. The auditor will observe if the different transactions and events are complete, if they actually occurred, if they conform to a cutoff, whether they correspond to the current period or the next period, if they are accurate, and if they are classified properly in the financial statements. Next, we have assertions about account balances. The account balances have their corresponding rights and obligations and are checked if they are complete, if they actually exist, and if they are evaluated and allocated properly. Lastly, we have assertions about presentation and disclosure in the acronym COCA. C stands for classification and understandability. Next, occurrence and rights and obligations, completeness, accuracy, and valuation. So these four apply to the presentation and disclosure in the financial statements. Next, we are going to take a look at audit procedures. So auditing procedures selected should enable the auditor to gather sufficient appropriate evidence about a particular assertion. So when looking at the financial statements, management comes up with assertions. And in order to test these assertions, we have corresponding auditing procedures. We have inspection, observation, inquiry, confirmation, computation, and analytical procedures. So we'll look at them one by one. In inspection, the auditor looks at records, documents, and tangible assets of the client. In observation, the auditor looks at processes or procedures being performed by others. For inquiry, the auditor inquires to persons inside or outside the entity. In confirmation, the auditor will corroborate the information in the accounting records. So the auditor looks at the client's accounting records, and in order to check if these accounting records really are in the correct and accurate amounts and information and economic conditions, the auditor will confirm. In performing the confirmation, the auditor communicates with external parties and related parties to see if these amounts in the financial statements really are true, accurate, and correct. Next, in computation, the auditor checks arithmetical accuracy. And in analytical procedures, the auditor will analyze ratios and trends. So in analyzing ratios and trends, the auditor is bound to see some fluctuations and relationships that deviate from predicted amounts. So in performing analytical procedures, the auditor studies the different patterns, and it's bound to see some fluctuations. Upon seeing this, the auditor will investigate these fluctuations and will see the reasons behind the financial statements are having unusual patterns, because behind these patterns, they might be errors, fraud, or non-compliance. So the auditor does this in order to ensure that the amounts or the representations and assertions in the financial statements are correct. Next, when accepting an engagement, the auditors decide whether to accept or reject an audit engagement. So what do we consider when we are deciding whether to accept or reject? First, competence. Next, independence. Then, ability to serve the client properly, and integrity of the prospective client's management. First, The firm should consider if the auditors and the engagement team have the right education, skills, and training to be able to perform the engagement. Next, the firm should check if it is compliant with ethical requirements. Then, the firm should also consider if it has enough personnel to actually conduct the audit process or the engagement with the client. Lastly, the firm will check if the prospective or future client's management is having integrity. In doing this, the firm can obtain permission to communicate with the predecessor auditor and inquire of the predecessor auditor. It will ask about the reasons why there is a sudden change of auditors, and if the previous auditor has disagreements with management and facts that involve the integrity of prospective clients' management. In accepting an engagement letter is made after accepting the engagement. So if the firm, the engagement team, actually decides to, yes, accept the engagement, they will often be creating an engagement letter. So the engagement letter is a written contract between auditor and client. In the engagement letter, stated there are the responsibilities of both parties, the responsibilities of the engagement team, the responsibilities of the client's management, the scope of the audit, and the expected reports that will actually be created in the process of the audit. Now we will be talking about audit planning. Okay, so what's audit planning? It involves understanding the client's business and industry. We have to do this, we have to understand the client so that we can identify the events, transactions, and practices that have a significant effect on the financial statements. So since audit planning is one of the starting steps in the audit process, it's more like studying the client, learning about the client. This involves learning about the client, maybe studying about the industry of the client, what does the client do in its business, and maybe even taking a tour of the client's facilities. Okay, main objective. Main objective of audit planning, determine the scope of auditing procedures to be performed. So in audit planning, as what we can infer from the name, planning, we are determining on what we are going to do throughout the audit. Since audits can be varied, the work involved in the audit can vary as well. The time involved, the amount of evidence that we need to gather during the audit, they all vary. We need to plan properly, and audit planning is this. It involves studying the client basically. In audit planning, the key things that we have to do, we have to develop an overall audit strategy, audit plan, audit program, and time budget. So as you can see from the screen, are the differences between the four of those. We go from the broadest to the narrowest. Okay, so the broadest among them all is the overall audit strategy. Here we see the scope, timing, direction of the audit. So scope of the audit, how deep we have to dig during the audit, how much evidence we have to accumulate during the audit. What will the audit cover? Will it cover up to the tiniest of details of the client? Will it cover specific areas in general, or specific areas will have to be focused on? We study all of those during the overall audit strategy. We also look at the timing of the audit. When do we perform this procedure? When do we perform that procedure? Then we look at the direction of the audit, where the audit is headed, the steps towards the completion of the audit. Next, the audit plan is a bit more specific. We see the nature, timing, extent of planned risk assessment, and further audit procedures. So in auditing, we have the risk assessment and further audit procedures. We will be talking about them later on, okay? Next, even more specific is the audit program, because in the audit program, we already have a detailed list of the audit procedures that we talked about a while ago, the list of these procedures that are necessary to accomplish the audit objectives. Take note, okay, these audit objectives are connected to the audit assertions. So audit assertion has a corresponding audit objective corresponding list of audit procedures. Lastly is the time budget. Of course, in performing an audit, we don't have an unlimited amount of time. So we have to budget this time. How much time do we need to spend for this procedure, for that procedure, the budgeting of the amount of time that we have in executing the procedures. In audit planning, we also come up with a preliminary assessment of materiality and risk. Take note, since it's only preliminary starting assessment of materiality and risk, which is subject to change as we go further in our audit, okay? First, what's materiality? It's the largest amount of misstatement that an auditor could tolerate in the FS and the smallest aggregate amount that could misstate the FS. So materiality is basically an amount, and materiality varies from client to client and also depends on the judgment of the auditor. Our next topic is audit risk. This is in line with audit planning because, as I've mentioned a while ago, in audit planning, we have to have a preliminary assessment of risk. So, what risk are we talking about? This is audit risk. What's audit risk? It's the risk that the auditor gives an inappropriate audit opinion on the financial statements. So, there is a chance that the auditor might say that these financial statements do not have any material misstatements, and these financial statements are fairly presented in accordance with the identified framework that we have, when in fact, these financial statements are not fairly presented, and these financial statements have very material misstatements. So the risk of that happening is the audit risk. The audit risk is the complement of audit assurance. So the audit risk and audit assurance go together. For example, if the audit has a 5% audit risk, it has a 95% assurance that opinion is correct. So these two add up to 100%. We have the audit risk model. So the audit risk is equal to three components: inherent risk multiplied with control risk and detection risk. So let's learn about each of these risks and see how they differ from each other. First up is inherent risk. It's the susceptibility of an account balance or class of transactions to a material misstatement, assuming that there were no related internal controls. So for example, let's say cash, with no relating internal controls to cash. We can see that cash has its own susceptibility to material misstatement, as well as other balances that require complicated computations, that require judgmental estimates, and inventory items maybe that are low in volume but high in value. Let's say the client has inventories of jewelry. They are small when you look at the volume, but they have high value. So they have a high inherent risk. They have high susceptibility to material misstatements, okay? Next is control risk. Control risk is the risk that a material misstatement that could occur in an account balance or class of transactions will not be prevented or detected and corrected on a timely basis by accounting and internal control systems. So control risk, of course, is related to our client's internal control. So it's the risk that the client's internal control will not be able to do what it is designed to do. It will not be able to prevent misstatements. It will not be able to detect and correct misstatements. Last is detection risk, the risk that an auditor's substantive procedure will not detect a material misstatement. So detection risk depends on the auditor, and it can be controlled by the auditor. When compared to inherent risk and control risk, these two risks are merely assessed by the auditor. The auditor will assess the amount of inherent risk and control risk, whether they are high or low. But detection risk can actually be controlled and manipulated by the auditor. It's the risk that the substantive procedures will not be able to detect a material misstatements. So the risk of material misstatement, this term is commonly used, ROMM, risk of material misstatements. It's affected by the first two risks that we mentioned earlier, inherent risk and control risk. Next, after audit planning, we look at the internal control and consider it. Okay, so what's internal control? It's the process designed and effected to provide assurance of achieving reliability of financial reporting, effectiveness and efficiency of operations, and compliance with laws and regulations. So in other words, the internal control is composed of processes and procedures. For what? For reliable financial reporting, to promote effectiveness, efficiency, and compliance. These are a set of processes and procedures to check and evaluate if the client's objectives as a business are being met, to control these and to make sure that the client achieves what its goals are as an organization. The stronger the internal control of our client, the more assurance it provides about the reliability of accounting data and financial statements. So in considering internal control, all we have to do is to obtain an understanding of the client's control systems, and we need to assess control risk. The client's internal control has many components. It can be summarized into the acronym CRIME. For C, we have control activities. What are the client's control activities? These are the physical controls of the client, information processing of the client, the performance reviews that the client has, and the segregation of duties in the client environment. Next, we have risk assessment. This risk assessment, which is a component of our client's internal control, is different from the auditor's risk assessment, okay? So when we talk about risk assessment of the client, it refers to the risks affecting the entity's business. For information and communication systems, we see how the client processes its transactions and how the client communicates with its staff, with management, and those charged with governance. So they need to have an adequate information and communication system for that. Lastly, in monitoring, not only the auditor and the engagement team and the firm, not only they need to have monitoring, our client needs to have monitoring as well. What will the client monitor? It will assess the quality of their internal control over time. Are they doing a good job at maintaining a good quality internal control, or are they becoming too lax? So last, for the control environment, we have factors for this as well. So in the client's control environment, we have the integrity of the client, its commitment to competence, the HR policies and procedures of the client, the assignment of the client's human resources, management philosophy of the client, the participation of the board of directors of the client, and of course, its organizational structure. So in considering internal control, we have test of controls, which is used by the auditor to obtain evidence about the effectiveness of the design and operation of internal controls. So when we are considering the client's internal controls, we need to check its design and operation to see if it really is effective. If these internal controls are just for show, or if they really do their part in preventing and correcting the misstatements that occur. Our next topic is auditing in a computerized environment. So in a computerized environment, we need to consider how is it different from an environment which is manual. So in auditing manual versus computerized environments, what do we have to consider? We have here a list of characteristics of a computer information system. So if our client has a computer information system, we can see a lack of visible transaction trails. So when compared to processes which involve lots of paperworks and documents which we can use as audit evidence and audit information. When our client has a computer information system, we see a lack of transaction trails because mostly the inputs are entered directly into their computer information system. We no longer have a paper trail. We don't have documents to consider in our audit. Next, when it comes to consistency of performance, the computers, the information systems that the client has will not get tired of performing the same controls, same processes again and again and again. The computers will be consistent in performing whatever procedures or controls that the client has programmed for it to do. Okay? Next, we have ease of access to data and computer programs. So when compared to different stacks of documents and paper files stored in vaults, we can see that it's much easier to access data when the client is using a computer information system. For any member, any staff member of the client, for any personnel, it's just easy to sit in front of a computer and have instant access to the data which our client has. We need to consider this when auditing a computerized environment. Next is concentration of duties. When in a non-computerized environment, there may be tasks wherein the custody, authorization, and record keeping of the different transactions is done by many people. Wherein if we go to a computerized environment, all of these duties may be performed at once by a single computer or a single person. We have a concentration of duties due to this computer information system. And when compared with a non-computerized environment, sometimes management or those charged with governance, they have to be the one approving the different transactions and performing transactions. Whereas in a computerized environment, we have systems-generated transactions wherein the computer program or the accounting system will automatically generate the transactions without the need for any human interaction. Next, of course, is the vulnerability of data and program storage media. When we compare it to a non-computerized environment wherein our documents, accounting records, and information are stored in papers, the way that we will lose our data is if we lose these documents and hard copy files themselves, wherein a computerized environment, the data is vulnerable since a simple click or edit to the different files in our computer will possibly cause damage or even lose our data. So in that way, our data is more vulnerable in a computerized environment. Are internal controls any different in a computerized environment? So when we have a computer information system, we have general controls and application controls. So general controls pertain to controls for the organization, systems development and documentation, access, and data recovery. So here in the general controls, we see the different policies and procedures when it comes to data recovery, what happens in the computerized environment if we lose our data, who has access to our data, about the different programmers who develop our systems. And these systems need to have documentation as well for future users to be able to know how to accurately process transactions and use these systems properly. For application controls, since in a computerized environment, there are inputs, there are processes, and there are outputs, we need to have controls over these as well, okay? How do we test controls in a CIS environment? So the answer to this question is through auditing around the computer or black box approach, or you can also use computer-assisted audit techniques or white box approach. What's the difference between these two? So When we do black box approach or auditing around the computer, the auditor will focus on input documents that you are entering into the system and the CIS output. You need to check if the input is processed accurately and correctly and will lead you to a correct output. You will not mind the computer processes, you will merely focus on input and if the input leads to a correct output. Versus the white box approach. So in the white box approach, the auditors use CATs. CATs are computer programs and data which the auditor uses as part of the audit procedures to process data of audit significance in an entity's information system. So, in a white box approach, instead of just focusing on the input and output, the auditor will use their own set of programs and audit techniques to be able to audit the client's CIS environment. So we have here examples of CATs. There are 4 listed on the screen. Test data, integrated test facility, parallel simulation, and other CATs. Let's start with test data. So in test data, the auditor will prepare fictitious transactions. Then the auditor will enter these fictitious transactions into the client's CIS environment, into the system, and the data will be processed by the entity's computer program. And through this, the auditor will be able to check if the input has the correct corresponding output. For integrated test facility, the fictitious transactions are mixed with ordinary transactions. So the management is not aware which transactions that the auditor inputs are fictitious, which of these are ordinary transactions. In this way, the management will be less aware of the testing of controls that are happening, and the management will be able to provide an output which is genuine and which are not tampered with. Next, in a parallel simulation, it requires the auditor to write a program that simulates the client's program, okay? So, in a parallel simulation, auditor's program versus client's program. And then they will be used to process the same transactions. The auditor will then compare the results of the client's program versus the auditor's program to see if there are any deviations or fluctuations when the client's program is used. Lastly, we have other computer-assisted audit techniques in the form of snapshots and systems control audit review files. So what's the difference between snapshots and SCARF? For snapshots, the snapshots are computer programs used by the auditor. The snapshots will take a literal snapshot of the process being performed by the client's program, and it will see what the client's program is doing with the different transactions. While for SCARF, it's a program that is embedded into the system and performs continuous monitoring. So snapshots, one-time snapshot only, while for SCARF, it performs continuous monitoring over time. We also need to learn about different transaction cycles that the client has. So a transaction cycle is a set of related business transactions. There are 5 major transaction cycles. We have the revenue and receipt cycle, expenditure and disbursement cycle, HR and payroll cycle, production cycle, and financing and investing cycle. So we need to learn what goes on in each of these cycles. Let's discuss them one by one. First, for the revenue and receipt cycle, it starts when a customer orders something from the client, and so it leads to a sales order. So after receiving the sales order from your customer, the client will check the credit capacity of the customer. It will ship the order. It will prepare a sales invoice, and then it will collect the payment. So that's what happens in the revenue and receipt cycle. For the expenditure and disbursement cycle, the client prepares a purchase order, it receives what it ordered, it records the liability, and then it pays the supplier. For HR and payroll cycle, the client acquires services, it records the time, verifies the hours for these services, it calculates the pay that it needs to pay to its employees, and then it pays its employees. For the production cycle, it's very familiar to us. It begins with the raw materials, then turns them into work in process, and then finished goods for sale. Next, for the financing and investing cycle, this is the cycle on how the entity generates its capital funds and then it invests these capital funds. Now we move on to performing substantive tests. So substantive tests are audit procedures designed to substantiate the account balances or to detect material misstatements in the FS. So we can see that the tests of control and substantive tests are related to each other. If tests of control indicate that the internal control of our client is effective, then the auditor may perform less substantive tests. But if we find out that the internal control is not reliable, the auditor needs to increase the extent of substantive tests. There are two types of substantive tests. First is analytical procedures. So what do we do in analytical procedures? We focus on accounts that are predictable and then check reasonableness and identify significant fluctuations. So income statement accounts are closed yearly. So every beginning of the year, we start fresh with our income statement accounts. This makes it easier to predict and more suitable to be subjected to analytical procedures. Those accounts that are not subject to management discretion and accounts that are in a stable environment are also more suitable for us to perform our analytical procedures. We take a look at an account, then the auditor gathers and creates expectations and predictions for this account. And then we will identify if these accounts have significant fluctuations and investigate why these fluctuated. For the second type of substantive tests, we have test of details. In test of details, we examine the actual details making up the various account balances. In test of details of balances, we have direct testing of the ending balance of an account, and in test of details of transactions, we have testing the transactions which give rise to the ending balance of an account. Let's say, for example, the cash account. When we test the details of balances, we look at the ending balance of the account of cash in our FS. So what is the ending balance of cash? And then we look at our actual cash, our cash in bank and cash on hand. We see if this ending balance is correct. In test of details of transactions, we look at the transactions. So we look at the accounting records and see the cash transactions, the inflows and outflows of cash that took place during the year. And we investigate these if these are correct and if these will lead to the correct ending balance of cash. We also need to talk about audit sampling. In audit sampling, we apply audit procedures to less than 100% of the items within an account balance or class of transactions. And we see to it that all of our sampling units have a chance of selection. When we perform audit sampling, we assume that the samples that we selected for testing represent the population. When we perform audit sampling, of course, there is a sampling risk. It's the possibility that the auditor's conclusion based on a sample may be different from the conclusion reached if the entire population were subjected to the same audit procedures. So when we talk about sampling risk, we have two types of sampling risks. First is alpha risk, then we have beta risk. For alpha risk, it's the risk that internal control, we assess internal control to be not reliable when actually in reality it is reliable. So it's the risk of under-reliance. It's also the risk that we conclude that a material misstatement exists when it does not, risk of incorrect rejection. So when we talk about alpha risk, it affects the audit efficiency, while beta risk affects the audit effectiveness. In beta risk, we conclude that the internal control is reliable when in reality it is not, the risk of over-reliance. Or it could happen when we conclude that material misstatements do not exist, when in reality, they do exist, or the risk of incorrect acceptance. When we have sampling risk, we also have non-sampling risk, which is the risk that the auditor may draw incorrect conclusions because of human errors. And we need to take note that when we are performing audit sampling, there are different sampling plans depending if you are using sampling for test of controls or substantive tests. And each of them, the test of controls and substantive tests, they have different sample selection methods. Now we have the auditor's report on financial statements. So we have been talking about gathering audit evidence. And once we have gathered the audit evidence that we need, the auditor forms a conclusion about the financial statements. Or in other words, the auditor forms an opinion. Then this opinion will be communicated to the interested users through the audit report. So there are many types of audit report that may be issued. So let's go through each one of them. The first one is the clean opinion or unmodified opinion. So this is the most common type of audit report. It's issued when the auditor concludes, based on audit evidence obtained, that the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework. Next, there are also unmodified opinions that have an emphasis of matter paragraph. For what? This is to draw readers' attention to a matter presented or disclosed in the financial statement. So this matter can be in the type of an uncertainty, a going concern, early application of new accounting standards, major catastrophes that occurred, subsequent discovery of facts that may have an effect on the financial statements, and the use of special purpose financial statements. So moving further, in the opinion, aside from those mentioned earlier, the clean opinion or unmodified opinion and the unmodified opinion with emphasis of matter paragraph. Diba? These two are unmodified opinions. So when there is a modification to the opinion that occurs, this may be due to a material misstatement or due to a scope limitation. First, a material misstatement is present when there is an inappropriate accounting policy that is used by our client, or maybe they misapplied an accounting policy, or they have an inappropriate or inadequate disclosure when it comes to some items in the FS. So when this material misstatement is material but not pervasive, it results to a qualified opinion. But if these material misstatements are material and pervasive, it results to an adverse opinion being issued by the auditor. Now, let's move on to scope limitations. Okay, this occurs when the auditor is unable to perform necessary audit procedures or they are unable to obtain sufficient appropriate evidence. If this scope limitation is material but not pervasive, it results to a qualified opinion. And if it's material and pervasive, it results to a disclaimer of opinion. Now, we move to completing the audit and post-audit responsibilities. So this is done after the fieldwork is almost complete and it's a set of procedures carried out to complete the audit. So there are four. First, we identify subsequent events. So these are events occurring after the balance sheet date. And these events, they may require adjustment or otherwise, they just require disclosure. Next, we need to identify contingencies, litigation, claims, and assessment because they might have a material effect on financial statements. Then we have to obtain written management representation. So these written management representations are a source of audit evidence for the auditor. And in the management representation, management acknowledges its responsibility for the fair presentation of the financial statements, and also it states its approval for the financial statements. Lastly, we need to perform wrap-up procedures, which may be divided into three: final analytical procedures, evaluation of the entity's ability to continue as a going concern, and evaluating audit findings and obtaining clients' approval for the proposed adjusting entries. So in the final analytical procedures, we perform analytical procedures throughout the various stages of our audit. But for the final analytical procedures, we merely look at them and perform them to see if there are fluctuations that are not previously identified, as well as to see if the evidence that we gain through our final analytical procedures supports our opinion. Also, when we evaluate audit findings and obtain approval for adjusting entries, we are doing this because throughout the course of our audit, we might spot some material misstatements, and of course, they must be corrected. Hence, the need for proposed adjusting entries and the client's approval for us to adjust. Next, we have the Professional Code of Ethics. So the Professional Code of Ethics is divided into three parts. For now, let's focus on Part A, the general application. So in Part A, general application, we are talking about the different fundamental principles. It can be summarized into the acronym POPC. As you can see, professional competence and due care. It involves the attainment and maintenance of professional competence. So as I've mentioned earlier, in performing the auditor's duties, the audit and the engagement team must have the appropriate competence, the education, skills, and experience to fulfill their responsibilities. Next, objectivity. They must be fair and free from prejudice or bias. They must have professional behavior. They must avoid actions which might bring discredit to the profession. Next is confidentiality. To know that we should avoid using or disclosing information without proper and specific authority given to us. And lastly, integrity must be present. Honesty and truthfulness. We also need to know the different threats to compliance with the fundamental principles that we have learned. These are self-interest, self-review, advocacy, familiarity, and intimidation threat. So for self-interest, it's a threat, that a financial or other interest will inappropriately influence the accountant's judgment. For self-review, it's the threat that a professional accountant will not objectively evaluate the results of the previous judgment. For advocacy threat, it's the threat that the accountant will promote a client's or employer's position. And when this happens, as an auditor or as a professional accountant, our objectivity is compromised. For familiarity threat, it's due to a long or close relationship with a client or employer. A professional accountant will be too sympathetic to their interests or too accepting of their work. Lastly, for intimidation, it's the threat that a professional accountant will be prevented from acting objectively because of pressures. And these pressures may be felt from the outside parties, external parties who would like to have an audit opinion that is according to what suits them, and in turn they will pressure the professional accountant so that the professional accountant will give an audit opinion that is more suitable to their liking. We also need to learn about safeguards. These are actions or other measures that may eliminate threats or reduce them to an acceptable level. We have safeguards created by the profession, legislation, or regulation. Examples are listed here, and also safeguards in the work environment, which of course may be firm-wide safeguards or engagement-specific safeguards. For Part B and Part C, we have situations and safeguards for professional accountants in public practice and for professional accountants in business. Lastly, we go to RA number 9298, Philippine Accountancy Act of 2004. So what's in this? The objectives for RA 9298 are the standardization and regulation of accounting education, examination for registration of CPAs, and supervision, control, and regulation of the practice of accountancy here in our country. So the scopes of practice: public accountancy, commerce and industry, education or academe, and government. The Philippine Accountancy Act is divided into 5 major articles. The first one being the title, declaration of policy, objective, and scope of practice, professional regulatory board of accountancy, examination, registration, and licensure, practice of accountancy, and penal and final provision. So these 5 articles are mainly factual in nature. They give us different facts regarding the practice of accountancy in the Philippines. So I have included a link below, and it contains the condensed version or summarized version of the act for your browsing. Okay, so we have reached the end of the presentation. Thank you very much for listening to me despite the information overload. I hope we all learned a lot from the overview of auditing theory. I wish you best of luck and may God bless you in your upcoming examinations. Thank you very much. That would be all.